I don't know if you've noticed, but this has been a pretty hard ski season for many ski resort operators. Chief among them is Vail Resorts, which has borne the brunt of the mainstream and social media attention throughout the past few months. There's a lot of curiosity swirling right now, so join us as we explore what's going on with Vail and what happens next if the company keeps tanking. Now, when you look at the numbers, it's true. Vail's not doing too hot. At the time frame of this video's scripting, Vail stock was trading for just over $131. The last time the stock was valued this low was right in the middle of the COVID pandemic, and even then, the absolute minimum was just under $132. So yes, Vail stock is now lower than it ever was during COVID. However, some other relatively prominent snowsports content creators have been claiming that what we're seeing now could be the end of Vail and that would be an unconditionally good thing. Both of those claims are circumstantial and poorly researched, so we're going to take a more detailed and analytical look at what exactly is going on and what comes next, rather than a knee-jerk reaction or an emotionally driven response. Before getting too deep, a quick disclaimer. We are not economists, nor do we have any insight to Vail Resorts. This video is made purely from historical context, outside observations, and personal predictions. Also, right as this video was written, our friends over at Peak Rankings released an excellent video about the Icon Pass and its current situation, which we'd recommend checking out right after this. Now to be clear, Vail is not the only operator that's struggling. However, Vail is the only publicly traded ski resort company in North America, which affords guests much more insight into the company's performance than its main competitor Alterra. There are a good number of companies with smaller footprints as well, such as Aspen Ski Co., Bear Den Partners, Boyne, MCP, PGR, Powder, RCR, and even Orta, although that last group is a government entity and as such also has its performance publicly accessible. Let me know of any other groups I forgot about. I list all of these companies for one very specific reason: the general mentality around the ski industry as a whole right now. People always want someone to blame, and in recent months we've noticed a massive amount of finger pointing at Vail and Alterra specifically. Many people like to blindly hate on Vail, and to a lesser extent Alterra, to say that it's solely those two companies who quote-unquote ruined skiing. This thumbnail shows Sun Valley, which is one of the few large ski resorts in North America that isn't owned by one of the companies we just named. Certainly not Vail. And this particular thumbnail is even more ridiculous because it shows the top terminal of a lift in Les Trois Vallées. The top terminal. At a non-Vail resort. In France. My point is that people aren't doing proper research. They're telling you what you want to hear because they know you all will click on it. So be very careful watching videos like these, because it's easy to just jump on the bandwagon and blame Vail for everything. Everybody wants to criticize, but y'all can't even bother to put in the effort to think for yourselves. At the end of the day, Vail and Alterra absolutely do take some of the blame for transforming the ski industry into what it is. But the notion that Vail single-handedly monopolized the industry and force-started the movement of building nationwide portfolios is false and exaggerated. How many of you knew of Peak Resorts or American Skiing Company back when they existed? I'm willing to bet that the majority of people who are publicly complaining about how skiing has been ruined never even skied in the quote-unquote glory days they're comparing it to. I'm certainly not Vail's #1 fan, far from it, but I have grown tired of seeing everyone blindly using Vail as their punching bag for problems that A, they don't understand, and B, extend well beyond the actions of that single company. One last thing before we get into Vail's performance specifically. We've noticed one particularly pervasive comment on social media in recent weeks. On videos and posts announcing terrain updates and showing snow conditions, the top comment has been, without fail, something along the lines of, "And they're still charging $350 a day for this." I understand that many of these comments are just hyperbole or to make a point, but this type of statement in the thousands of likes that they get are plainly uneducated. While it isn't untrue that ski resorts, and not only those that are Vail owned, charge exorbitant day rates, those are prices that a fraction of a % of their visitors pay. These prices are high not solely for the purpose of being high or to spite the Instagram commenters, but to drive people to the pass model. At Vail Mountain in Colorado, the highest day ticket rate this season was $356. However, the effective ticket price, a metric used to measure what the average visitor spent for a day, was only $134. For reference, the day ticket rate for Loveland in the peak season was $149. There is a common misconception that passes have simultaneously increased prices and crowds. We've covered this extensively in other videos, but for a large portion of skiers in dense regions like Colorado, Utah, Tahoe, and the Northeast, passes like Epic and Icon have actually made skiing cheaper. Of course, that doesn't apply for everyone, but when you take a step back, it only makes sense that if the passes increased crowds, it must be because they increased accessibility. And in this sport, accessibility is largely equivalent to price. Now that we've addressed a few of the swirling narratives around Vail, let's dive into what exactly has been going on, starting by reviewing their long-term stock performance. We already discussed how the current stock price is lower than it was at any point during the pandemic. In fact, the last time under normal circumstances that Vail stock was this low was in April of 2016. At that time, Vail had 12 mountains, didn't own Whistler, anything in the Midwest or Northeast, nor anything in Europe or Australia. It was a fraction of the size it is now. Now compare that to a high of 372.51 achieved on November 5th of 2021, right at the height of resurgence of outdoor activity following the pandemic, along with the corresponding recovery by the company. So how in the world has Vail stock fallen so drastically? The answer is, of course, exceptionally nuanced. However, the primary driver is largely that the conditions that drove the 2021 peak have reversed. During the pandemic recovery, skier visits hit record levels, but since then visitation has normalized while growth has slowed and, in some seasons, declined. Epic Pass sales have begun to decline, and at the same time, Vail has faced a string of operational and macro headwinds. Inconsistent snowfall and unusually warm winters have reduced skiable terrain and cut visits, directly hurting revenue and forcing guidance cuts. Profitability has also been pressured by rising labor and operating costs, alongside reputational and service issues that have made investors more cautious about long-term demand. The reputation in particular has been significantly damaged by a string of flat-out failures, including but not limited to the Stevens Pass debacle of early 2022, the Park City and Keystone lift rejections of that summer, and the Park City patrol strike of New Year 2025. On top of that, the stock was arguably overvalued at its 2021 peak, so the combination of weaker earnings, declining visitation, and reputation damage has led to a significant repricing, leaving share values down to just 30 to 40% of their highs. This diminution of the company's valuation has coincided with a more measured approach to investment across Vail's portfolio. After the aggressive expansion and lift upgrades of the early 2020s, the company has slowed the pace of new projects and acquisitions in recent years. Ever since the epic lift upgrade of the summers of 2022 and 2023, which saw 23 lift projects combined, Vail has undertaken only 4 projects across its 36 mountains in North America, with only 3 more announced for 2026. Additionally, since they closed on Switzerland's Crans-Montana in May 2024, Vail hasn't expanded its portfolio of resorts. Vail hasn't expanded in North America since December of 2021, when it purchased a trio of mountains in Pennsylvania. On the whole, a major contributor to this downturn in valuation has been lower overall visitation. Vail Resorts reports their earnings quarterly, but their most important resort is that of the second quarter, which occurs in early March. This session covers the holiday periods and the peak months of January and February. As such, we'll compare the Q2 earnings report for the past few years. In the 2026 call, it was revealed that the season to date compared to the previous year through March 1st, North American skier visits were down 11.9%, with lift revenue down 3.6%. This may seem mismatched, but it's because season pass holder visits were down 14%, while those who bought day tickets were only down 6%. In other words, the people who were skipping out on skiing were primarily those who had already paid for their pass, which is why revenue didn't dip as much. Nonetheless, 3.6% is a significant figure for a company with such a high overall income as Vail. However, much of this can be attributed to the poor winter seen across the American West this season. So let's back up a little bit further. In the Q2 call for 2025, lift revenue was up 6.9% from the previous year. According to then CEO Kirsten Lynch, visitation to North American resorts was slightly above prior year levels. However, the earnings report itself stated that visitation was down 2.5% compared to the previous season. The call for 2024 indicated an increase of 2.6% in lift revenue against a decrease of 9.7% in skier visits. All of this should be of note to you because on first glance, it doesn't make much sense. How can a company increase its revenue even with fewer customers? How can that company's stock take a nosedive even as revenue continues to increase? The answer is that Vail has fundamentally changed how ski resorts make money. This isn't really a pay-per-use business anymore, it's a prepaid access model. Through the Epic Pass, a large portion of revenue is collected before the season even begins, so when visitation drops, it doesn't translate one-to-one into lost revenue. The company has already captured much of that income, and that helps explain why, even with declining skier visits in multiple seasons, Vail has still been able to grow lift revenue. While the unfortunate reality is that this model has spawned many other challenges within skiing as a whole, ski resort operators would be in serious trouble in a season like this without this business model. Despite the relative stability of the business model, the company did see a major shakeup in 2025, a new CEO. The outgoing CEO, Kirsten Lynch, has served since late 2021, seeing Vail through some of its highest highlights, but also through some of its most existential challenges. In the end, it seems that she may have been better suited to her data science degree than trying to empathize with the overall skiing experience, although it's not exactly our place to criticize. Nonetheless, her replacement was none other than Rob Katz, who was also her predecessor. Katz was the driver behind the creation of the Epic Pass and was the party responsible for turning Vail from a small 5-mountain group in 2006 to the continental conglomerate it was in 2021. This leadership shift matters primarily because it signals a return to the strategy that built Vail's current business model in the first place. One of the first things Rob Katz did after his return was to change the buddy ticket model, introducing the new 50% off model we see today. Notably, the Epic Pass holder must be present with the friend in order to redeem, while Icon's friends and family tickets do not have such a restriction. One other action of note by Rob Katz was his recent purchase of nearly $5 million in the company's stock. This is a stark contrast from Kirsten Lynch, who did not have much of a stake in the company. Before looking to the future, there's one final recent headline worth discussing. A class action lawsuit filed in March alleging that both Vail Resorts and Alterra Mountain Company violated state and national antitrust laws in their past sale tactics. On the surface, this seems to be a lawsuit centered around the increase in ticket prices. However, as the Storm Skiing Journal broke down in the excellent article linked in the description, it's about something different. In essence, the lawsuit claims that the push by the companies for the consumers to buy the multi-mountain passes forces the consumer to purchase access to the entire portfolio, which they surely won't use the entirety of. Therefore, the pass is overpriced because one must pay for access to mountains that they won't visit. For example, someone who buys the pass for their Steamboat and Winter Park trips is also forced to pay for Stratton and Sugarbush despite having zero intentions of visiting those latter two mountains. While that argument may sound intuitive at first glance, it runs into a pretty fundamental issue. Consumers aren't being forced to buy anything. Despite the marketing pressures to buy the larger passes, both Vail and Alterra still sell day tickets, and, in many cases, single resort passes. The multi-mountain passes are optional products, one that often offer more flexibility at a lower per day cost for frequent skiers. More importantly, bundling access to multiple resorts isn't inherently anti-competitive. It only becomes a legal issue if it prevents competitors from entering the market or forces consumers into purchases they otherwise couldn't avoid. We covered in the very beginning of the video the huge numbers of other companies in the North American ski industry, and contrary to popular belief, there are a good number of independent resorts that continue to thrive as well, even in competitive markets like Colorado's Loveland and Wolf Creek face. All that's to say that, on the surface, the lawsuit is a difficult case to make in an industry where alternatives still exist, even if they're more expensive or less convenient. That doesn't mean skiers are wrong to feel that prices have gone up or that the value equation has changed, but those are consumer sentiment argues, not necessarily antitrust violations. And as a result, this lawsuit likely says more about frustration with how skiing has changed than it does about any clear-cut violation of antitrust law. We're certainly not lawyers, but we find it rather unlikely that the court sides with the plaintiffs in this particular scenario. So with all of that on the table, I'd like to make one very clear claim. Vail is not dying, contrary to what many will say. Remember those earnings calls we mentioned earlier? At the 2025 Q2 call, the company's EBITDA margin was around 29%. The 2026 Q2 earnings indicate an expected margin of around 26.5%. These margins are extremely strong for this asset-heavy and weather-dependent of a company, and are indicative of the fact that Vail Resorts is not in fact floundering. However, This certainly could change if the lawsuit does prove successful, but if that does come true, we're not talking about a new challenge for Vail Resorts, we're looking at a cataclysmic shift across the ski industry as a whole. Many people have looked singularly at the stock performance of Vail and have made assumptions based off of that. One common point of discussion is whether Vail would consider selling off resorts. While it's absolutely not out of the question, we find it unlikely that, even with the stock performance, Vail would sell mountains. Vail's business model includes turning visitors to small regional hills into epic pass holders who visit the bigger destinations in the northeast or western regions. So while from the outside it may not seem to make much sense for them to continue to hold on to Alpine Valley and Big Boulder, it makes more sense within their portfolio as a whole. Given the operating margin, it would likely be a folly for Vail to disrupt their network by selling off mountains, no matter how poor the performance of that individual resort was. Even if Vail did attempt to sell mountains, who would buy them? In recent memory, Powder tried to sell off several of its mountains and only succeeded in selling 3. Killington Pico went to a group of local investors. And in what might be one of the most inspiring and incredible stories of this season, Eldora Mountain in Colorado was sold to the town of Nederland. However, they failed to sell Mount Bachelor, and they sold Silver Star to Pacific Group, which is another multi-mountain operator. There only exist so many local groups that are interested and wealthy enough to buy a mountain, and there are very few towns with the willpower that it took Nederland to buy Eldora. In the more likely case, Vail would put a low-performing mountain on the market without anybody local with the power to buy it. In that case, it would be a rather unappealing option to other companies and would likely end up with no takers. Even if it was sold, it would likely be sold to another multi-mountain operator. Regardless of the specific outcome, selling off the mountains isn't just as simple as listing them on Facebook Marketplace, and the result may not be as favorable as it initially looks. Nederland and the group that bought Killington Pico both still have a long way to go to prove their economic viability as standalone independent resorts once again. Now, there seems to be this common sentiment that if Vail disappeared tomorrow and all of its resorts went back to local ownership, the world would be an incontestably better place. While Vail has inarguably shaped the ski industry into what it is today, we often fail to recognize all of the good that it has brought. A ski resort like Alpine Valley or Big Boulder might not survive in today's era of weather and visitation volatility. And conversely, the portfolio of multi-mountain passes allows for access to Keystone, Breckenridge Vale, and Beaver Creek all in the same trip, which can sometimes help spread crowds out. There is no doubt that some things would get better, but it is important to recognize that not everything would be good without Vail and Alterra. We complain about these issues brought on by the Epic and Icon passes and wish death upon their parent companies, not realizing that without these models, there very well may not be anything to complain about, not because everything is good, but because skiing as we currently know it just doesn't exist in some places. I'm not out here saying Vail is uncircumstantially making the world a better place, but I will refute the claim that Vail is entirely evil and the world would be undoubtedly better off without the company. This is an issue that requires nuance, patience, and research, 3 things you don't often find on an Instagram reel or in its comments section. As such, I encourage you to think for yourself. Disagreeing on the fact that Vail is the worst thing in humanity does not make you a Vail fan. It makes you someone who can think about an issue without letting emotion get in the way. At the end of the day, we're never going to be Vail's top supporter, but we recognize that a few bad numbers does not mean an entire company or industry is dying, and we appreciate any and all skiing we can get, whether because of or despite the work of Vail Resorts and the many other companies that contribute just as much. Of course, there are going to be many different perspectives on such a complex topic, and we'd love to hear any and all of your thoughts down below. As always, thank you all so much for watching. All my love, I'm out.